oil prices and Bitcoin. You know, on the surface, you wouldn't think they have much in common at all. But what if I told you that a sudden spike at the gas pump could actually trigger a major sell-off in your crypto wallet? Well, it turns out there's this hidden connection, and we're about to break down exactly how it all works.
I mean, think about it. When you see oil prices shooting up, your first thought is probably, gas is going to be expensive, right? Or maybe you think about heating bills. But if you're holding any crypto, there might be a much bigger financial risk playing out behind the scenes. So let's dive into that.
Now, the first thing you might try to do is pull up an oil chart and a Bitcoin chart and put them side by side, looking for a pattern. But here's the weird part. You're not really going to find one. Study after study confirms that on a day-to-day basis, the direct link is just not there. It's super weak, super inconsistent. So if they aren't moving together directly, what in the world is really going on?
Right, so if it's not some simple one-to-one relationship, what are we all missing? Well, the real story isn't about a direct link at all. It's about a chain reaction. It's about a series of dominoes that get knocked over, starting with oil and ending right at the doorstep of assets like Bitcoin.
And that brings us to the main event, what we're calling the macroeconomic domino effect. See, an oil shock doesn't just stay in the energy market. Oh no, it sends these ripples across the entire global financial system. And understanding those ripples, well, that's the key to everything. Okay, let's walk through these dominoes one by one. It all kicks off with step one, a big spike in oil prices. That immediately lights a fire under inflation fears, because, oil is in practically everything. So, what happens next? The central banks, they get nervous, and they step in to tighten policy. That's just their fancy term for raising interest rates. And this, right here, is the crucial move. Raising rates basically acts like a giant vacuum, sucking liquidity, all that easy money sloshing around the system, right out of the market. And when that pool of money starts to shrink, investors panic and start dumping their riskiest investments first. Which leads us to the final domino, a sell-off in speculative stuff, and yes, that includes Bitcoin.
Here it is, the whole chain of events perfectly summarized. Oil goes up. That leads to inflation fears, which causes central banks to hike rates. That, in turn, drains liquidity from the system, and the final result is that speculative assets, like Bitcoin, get hammered. It's not a direct hit, it's an unavoidable chain reaction.
Okay, so this whole domino effect brings us to a really, really important point. It completely challenges one of the most popular stories you hear about Bitcoin, the idea that it's a hedge against inflation, some kind of digital gold. But when inflation is being driven by an oil crisis, Bitcoin starts to show its true colors. So you've got this split personality, right? On one hand, there's the story we all hear. Bitcoin is digital gold. It's the thing that will protect your money when prices are rising. But the reality, especially during these oil shocks, is that it behaves a lot more like a risky tech stock. When fear takes over the market and everyone's running for safety, Bitcoin is often one of the first things they sell, not the last.
And listen, this isn't just a hunch. The data here is absolutely striking. At times, the correlation between Bitcoin and the tech-heavy NASDAQ has hit 0.8. Now, for you non-stats people, a correlation of 1 is a perfect match. So 0.8, that is crazy high. It basically means when tech stocks take a dive, Bitcoin is right there with them, often falling even harder.
So here's the bottom line. The research is pretty darn clear on this. When you're facing an unexpected inflation spike that's being driven by oil prices, you just can't rely on Bitcoin to act as a safe haven. It's a really risky strategy because its behavior in these specific situations just doesn't line up with a classic safe haven asset.
But wait, the domino effect isn't even the whole story. There are actually two other things that can make the situation even worse for Bitcoin during an oil shock. We're talking about mining costs and the strength of the good old US dollar. All right, first up, energy costs. As you probably know, Bitcoin mining uses a mind-boggling amount of electricity. So when oil prices jump, miners' power bills go through the roof. This totally squeezes their profits, and sometimes it forces them to sell the Bitcoin they've just mined simply to cover their costs. And that, of course, adds even more selling pressure to the market. Then there's the US dollar. When the Federal Reserve gets aggressive about fighting inflation, the dollar usually gets stronger. And a stronger dollar tightens the screws on global liquidity even more. And this relationship between Bitcoin and the dollar is incredibly consistent. Bitcoin has what's called a strong inverse correlation with the US dollar index. That's just a fancy way of saying they tend to move in opposite directions. As you can see on this chart, that negative correlation can get as strong as negative 0.8. So when an oil shock makes the dollar rally, it creates this powerful headwind that just pushes Bitcoin's price down. It's a real double whammy.
So after all that, what does this actually mean for you, the investor? We've gone through the mechanics, so now let's boil it all down into a clear risk radar. These are the main things you need to be watching when you see oil prices starting to creep up.
All right, here's what should be blinking on your radar. First, you're watching for any sign of prolonged inflation, because that keeps the pressure on central banks to do something. That something is aggressive monetary tightening, which, as we know, pulls money out of the market. You're also watching for a strengthening US dollar, which is a major headwind. And all of this creates this general risk-off mood in the markets, where investors just sell their riskiest stuff, which can lead to these sudden liquidity squeezes and really sharp price drops.
So, here is the single biggest takeaway for how to navigate this whole thing. Stop staring at the oil and Bitcoin charts right next to each other. The secret isn't there. Instead, watch the dominoes that fall in between. Pay attention to the inflation data when it comes out. Listen very carefully to what central bankers are saying in their speeches, and keep a close eye on what treasury yields are doing. Those are the real clues. They're the leading indicators that will tell you how that oil shock is actually making its way through the system towards your crypto.
And that leaves us with one last question to chew on. We spend so much time thinking about the risks to crypto from a tech perspective. Hacks, scams, bugs in the code. But in this interconnected world, maybe the biggest risk to your portfolio isn't a hacker in a dark room, but a central banker in a boardroom, just reacting to the price of a barrel of oil.